Do we really need to invest our money? Could we not just save our money for 30 to 40 years, have a bunch of money sitting in the bank account and live off that? Well, in this video, I'm going to cover off why financial freedom is important and if we can actually save our money based on some calculations, get to financial freedom by the age of 65. And I'm going to compare that to if you were to invest in a property, just one single property, and what difference that would make. If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Occasionally I'll jump into the whiteboard, showcase my amazing handwriting skills, and probably trigger most people that watch the channel because I opt for a contrarian view when it comes to investing. And apart from the fact that I definitely am not a financial advisor, I like to look at stats, graphs, and economic cycles because yes, I'm a nerd. So let's continue. So the topic here is save versus invest. A lot of people talk about saving money. A lot of people are talking about investing money and how hard it is, especially during a recession. People get worried, they're uncertain about what their investments look like. Let's dive into what most people do and what we can learn from those people to then retire early and financially free. Now, we definitely know a lot of people that fall into this bucket, and it might be yourself as well. So it might be something to keep an open mind about. But we all know people that work 9 to 5, they buy their own home to live in. They also work for 40 years and then live off the super, savings, and pension. Unfortunately, this is what we got taught basically at school. You know, you go to school, go to university because that was the only way you could actually be successful in life, apparently. Then go get a job, continue working your way up the corporate ladder, get married at some point, have some kids, buy your own home, and live the dream, which is effectively saving as much as you can, put it into a bank savings account, and then hope that the market sort of continues to do what it needs to do, and then eventually you'll have enough savings and super to actually retire. It's safe to say, based on my level of sarcasm, this is probably not the way that you want to be doing it. If you are watching this video, you already know this is the mistake that most people are making and is one that you're trying to avoid. Now, the topic of financial freedom has become a more interesting topic and something that more people are interested in during this pandemic because, hey, everyone was sitting at home doing nothing. And people realized that, hey, I actually don't like what I do. Let me see if there's other options. Unfortunately, the root of most of our problems is money. If we can solve that money problem, we may get into a position where we are happier by doing things that we actually like. So financial freedom is about retiring early. It's about doing what you love and being happy. No, I don't think money directly relates to how happy you are, but the money allows you choices to then be able to be happy doing what you love. I realized how poorly constructed that sentence was, but we're just going to avoid that and continue. So the question is, can we save our way to financial freedom? In this example, 25 years old, we have an average savings rate of 3%. So that's basically what the bank is giving us if we put it in the bank. And we're starting our income at 100K per year. Now, so many people are watching this going, at 25, where are you making 100K? Some people at 30, 35 are not making 100K, and some people may never make that. There are also some people going, well, this is for 100K, I make 150K. The point I'm trying to make is that this example is not going to cover everyone. It's just to illustrate a point. What you can do after this video is actually go in and substitute your numbers into this and see what your results would look like. But essentially 100K income with the 3% yearly CPI increase that most people get and an average savings ratio of 10%. Now, the average savings ratio in Australia is actually less than 10%, and during the pandemic went all the way up as high as 20%. But over the last 40 years, it's been declining because we don't have enough money to pay for our normal goods as the cost of everything goes up. So assuming 10%, that means we are saving $10,000 a year, which would work out to be $833 a month. Now, we're going to be compounding this at 3% because, again, we are saving that in a bank savings account. We're not just leaving it in a normal account, we're actually going to go put it into a savings account that all the banks have. Now, what I've done here is that although we're going to get a 3% increase, I'm going to basically cancel each other out. We know that inflation is usually about 3%. Well, that's what they tell us. But we're going to go, if your CPI increase for your income is going up by 3% and CPI is 3%, that means in real dollar terms, your money's actually not increasing. So before you get happy because your boss gave you an increase of 3% or even up to about 6% this year, it's not because you're special. I'm sorry to burst your bubble. It's just because CPI has been so high that they need to pay you a lot more for you to be able to do exactly what you did last year in the same capacity. Let's move on. So from there, all I did was put it into a compound interest calculator, and I'll leave the link in the description below so you can substitute it with your own numbers. But essentially, after 10 years, you'd be left with 129,000. After 20 years, you'd be left with 290,000. After 55 years, you'd be left with 506,000. And after 40 years, you'll be at the age of 65. And in Australia, for most, that is when you're going to be receiving your pension as well as your super, and that means you'll be at $796,000. Now, if you're in a couple and they happen to do the exact same thing that you just did, that means you're going to be left with $1.592 million. So almost $1.6 million in cash money that's sitting in your bank account.
I'm not sure why I said it like that, but okay.
Now, it's important to note, we haven't calculated one of your biggest purchases that you'll ever make, which is your house. Now, an average home in a major capital city is about $800,000. So I've put here approximately $200,000 would go towards that, and that would affect the end goal or the end number that's present here, but it's important to just keep that assumption in mind. So effectively, if we did this and we did this with a partner, we went ahead and just continued saving, that would mean that we would have 1.592 million. And if we continued saving that at the bank at 3%, that would mean that we are making $47,760 a year, and that would work out to be $23,880 per person. So there was a lot of numbers there, a lot of calculations. You can definitely go back and rewind, but let's break this down. This effectively means that for the next 40 years, I'm going to continue saving at the same rate. I'm assuming a lot of things here. I'm assuming the fact that I haven't bought a home. I'm also assuming there's no major purchases. And I'm also assuming that I'm not changing jobs. I'm pretty much staying in the same job, or I'm increasing, but the pay hasn't really increased that much. The other assumption, which is quite big, is that I'm also in a couple where my partner is doing the exact same thing that I want to do. Again, financial compatibility is super important. If you're someone that's sitting there watching it with your partner, then great, because you're on the same page. If you're not watching it with your partner, I suggest you share this video with them, because you guys need to start getting on the same page. So the question is, does this look like financial freedom? Well, it still accounts for the fact that you have to work 40 years. And even after 40 years, at an average savings rate, you're going to end up with about $25,000 per person in income. Now, could this be enough? Well, if you haven't bought your property and you're renting, I can tell you that won't be enough. But in addition to this, you'll also have super, which might account for maybe $200,000-300,000. So you could add that into here as well. But let's compare apples with apples. And what I mean by that is we're going to use the exact same sort of assumptions and numbers to then see if you made one simple investment choice. If you made that investment into a property, and I'm talking about an investment property that doesn't have to be expensive. In this example, we're going to use $350,000 as a property price. So what we've got here is the average growth rate in Australia for Australian property is about 7%. So let's assume CPI is 3%. That means the real growth in property is about 4%. So although you're getting really happy about the 7%, if inflation has been accounted for at 3%, you're really only growing by 4% and getting ahead of the market. Now in this case, because you started work at 25, I'm going to assume for 7 years you've been continuing to save, and the savings will allow you to have a 10% deposit to go and buy a property for 350K. Now, where did I pull this number of 350K out from? Well, it's the average price of the property that we purchase for clients as part of the buyer's agency. So we look at property all across Australia, and we look at 3 and 4 bedroom brick homes only. So I'm not accounting for units here. I'm not looking at townhouses. I'm looking at full brick family homes. Now, before you sort of jump into the comments and say, well, that's not possible anymore, we are doing this in 2022. So yes, it is still possible. And we're also going to assume a break-even cash flow. Now, most of the properties I purchase for myself as well as for the clients, we are going into positive cash flow territory, which means this example is going to be your worst case if you were to go and buy a good productive asset with good cash flow. In this, we're assuming all of your costs are basically evening out to be what you earn in terms of income from rental income, and they just basically cancel each other out. So what do the numbers look like here? Now, again, we're assuming that you can actually get a loan. So if you're getting a loan at 90% or 88%, then this is what your numbers would look like. At 35, which will only be in 3 years' time, given you're starting at 32, your property would be worth $393,000. At 45, which is 13 years away, it'll be worth $582,000. At 55, which is 23 years away, will be worth $862,000. And at 65, which is 33 years away, will be worth $1.27 million. Now, it's important to know that most loans here in Australia mean that you're going to pay it off interest plus principal over 30 years. So by the time you turn 65, you'll have already paid off this property. The bonus here is that if you're in a couple and you expect your partner to do the exact same thing like the example previously, then we can expect to have 2 properties worth $1.27 million, and that would work out to be $2.54 million in terms of asset value. So if we compare that to how much cash we had left over, that would be $1.6 million compared to $2.5 million, which is about a $900,000 difference. Not only that, but in terms of how much cash flow you'd be actually making, it works out to be about $76,000, which is about $38,000 per person. Again, we're not assuming that fact you're gonna go out there, purchase your own property, but the big advantage here is by using leverage and using it properly to buy the right asset, you're only putting out that money in the beginning. Once you've done that and you've purchased your property, you can continue saving like the first example. I'm not against saving money. I think everyone should have an emergency fund. And if you feel more comfortable as part of your risk appetite and your strategy to go and save a larger portion, well, in this example, you could do both. You could go out there, invest in property and potentially use the equity to purchase more properties, or you could use the excess savings that you're gonna make from your salary to then go ahead and continue with the risk off strategy of the first example, which is you save your money in a bank account, you have your property going up in value, you're still saving money in the background, and it means you get best of both worlds. So after going through this example, it's safe to say there were a few assumptions made in this video, but to cover every single scenario or every single possible assumption out there, it would simply make it impossible to make it into a video, and that too under 15 minutes. I hope you guys have enjoyed this video, and hopefully this has actually been an eye-opening experience for you, because some people have gone, I don't want to invest my money because I'm losing money, I don't want to take on debt, I'm scared of that. But it really is about rewiring your brain. If you are interested in understanding how your mindset can really shift when it comes to investing, as well as investing in real estate, there's an online course that I've created for you guys called Confusion to Clarity. The whole purpose behind that is to get you ready to buy either your first property or to go and invest in your first property. I'm adding new modules later this year, and that update will be completely free to whoever's actually got access to the course. So sign up today, there's a link in the description below. I'll catch you guys in the next one. Thanks guys.